Welcome to another explainer. Today, we're digging into one of the absolute most fascinating and honestly polarizing companies in the aerospace sector right now. We're talking about Voyager Technologies. Now, this is a company operating right at the bleeding edge of space infrastructure and national defense. But beneath all the shiny rockets and those futuristic space station designs, there is a wild financial duality going on that is literally tearing Wall Street apart. $275.3 million. Let that sink in for a second. That right there is Voyager's record-breaking Q1 2026 backlog. And to put that into perspective, it represents a staggering 54% year-over-year explosion in demand for their tech. I mean, customers are lining up, massive contracts are being signed, and if you're just looking at this metric alone, business is absolutely booming. But then, we get a severe case of financial whiplash. Negative $127.12 million. That is the company's trailing 12-month net loss. So for all that incredible backlog and top-line momentum, they are just burning through capital at an astonishing rate. Okay, let's dive into this, because we have a company showing just incredible strategic momentum on one hand, yet facing severe, very real cash burn on the other. So, which is it? Are they perfectly positioning themselves to essentially own the future of space and defense, or are they just incinerating shareholder value right on the launch pad? To really grasp the financials, we first have to understand what Voyager actually does day to day. They operate in what military strategists often call the ultimate high ground, space and defense. We're talking about the whole shebang. Everything from next-generation space infrastructure, like their massive Starlab commercial space station, all the way to national security propulsion systems, advanced electronics, and crucial missile defense tech. They are building the actual physical hardware that the US and its allies increasingly rely on. And the thing is, they aren't just drawing up fancy plans on whiteboards anymore. They are pouring concrete. Voyager is actively building massive physical infrastructure to handle really high-volume, military-grade production. For example, they've got the brand-new Space Beach facility out in California for advanced electronics, and they just broke ground on a massive 150,000 square foot expansion of the Voyager American Defense Complex in Colorado. That's specifically designed to scale up their propulsion and energetics manufacturing. Part 1. The bull case. Explosive growth. There is a very good reason why a rather large faction of Wall Street is incredibly excited about Voyager's trajectory, and this brilliantly illustrates why. It all comes down to revenue compounding. Look, they went from $144 million in fiscal year 24 up to $166 million in 25. That's solid. But their guidance for 2026? It projects a massive bump into the $230 to $255 million range. We're talking an aggressive 38 to 53% year-over-year growth rate. Now, this aggressive growth isn't just happening in a vacuum. Listen to this quote from their CEO, Dylan Taylor, during their recent Q1 earnings call. He said, "The scale of demand being signaled by the Department of War is historic, with Golden Dome now framed as a generational, multi-domain investment." Voyager's management clearly views this current geopolitical landscape, along with major defense budget tailwinds, as a literal once-in-a-generation opportunity to rebuild the domestic industrial base. And they see Voyager acting as a critical, central node in all of it. And frankly, they're securing the catalyst to back that up. I mean, just in the last few months, they've announced a $16.5 million DARPA contract for advanced propulsion. They snagged a major pre-production partnership for Raytheon's Standard Missile-3, and, oh yeah, they were just selected for NASA's PAM-7 private astronaut mission. Plus, they're playing offense, aggressively consolidating the industry. They recently signed an agreement to acquire lunar delivery pioneer Astrobotic for up to $300 million. It's a massive power cut. Part 2. The bear case. Cash burn. But, as they say, space is hard, and it is incredibly expensive. Critics are quick to warn that Voyager's financial realities are starting to look a lot like a rocket failing to launch. Now, what's really interesting about this analysis is the independent report from Koala Gains. They heavily criticize Voyager's historical track record, pointing out that, hey, actual top-line growth back in fiscal 24 was a very modest 5.97%. And as that revenue trickled up, their operating margins rapidly deteriorated, which suggests some very real systemic struggles to scale operations efficiently. So you might be wondering, how exactly do you fund those accelerating losses? And, a $300 million acquisition of Astrobotic? Well, you issue stock. Lots of it. Back in fiscal year 2023, Voyager had about 8.28 million shares outstanding. Fast forward to today, that number has exploded to nearly 59 million shares. Basically, existing shareholders have been massively diluted just to keep the lights on and keep funding this super aggressive M&A strategy. Which brings us right to their most recent quarter. In Q1 2026 alone, Voyager posted a staggering net loss of $44 million. And a huge driver of this? Their innovation spend. Research and development is currently eating up roughly 48% of their net sales. They're literally pouring money into the future, but they are bleeding heavily in the present to do it. Part 3. Wall Street's verdict. So we've got this historical cash burn and massive dilution on one side, right? And explosive future revenue guidance and historic defense contracts on the other. Let's move to ETEL and see how this builds into the broader market consensus. Because, surprisingly, there actually is one. Out of 11 institutional analysts, a combined 72% rate the stock as either a buy or a strong buy. Only 9% actually have a sell rating on it right now. When we break down the arguments side by side, you can see exactly how the market is weighing the incredible technological promise against the stark financial risk. The bulls, they see a strong consolidator capitalizing on undeniable national security demand with massive game-changing upside from their Starlab space station. The bears, however, hit back hard. They warn the company is way too dependent on NASA, that these aggressive acquisitions are just masking deep organic struggles, and that Starlab is still a massive financial risk that absolutely needs hard construction contracts to be viable. But, at least for now, the bulls are definitely winning the argument on Wall Street. The average analyst price target for Voyager sits at $44.09. Based on current trading levels, that implies a massive 54% upside. The street clearly believes that the future revenue is eventually going to outpace the heavy spending we're seeing today. Part 4. Will Voyager launch or crash? Synthesizing these opposing forces really just comes down to a crucial balancing act. Yes, they are burning fuel incredibly fast. They're expecting $60 to $70 million in capital expenditures this year alone, just to get production scaled up. But, and this is important, they aren't flying blind. They ended Q1 with a total liquidity of $641.4 million in cash and available credit. So the crucial point is, they've built up a massive war chest to potentially survive this incredibly expensive trip to profitability. So here we are. They have the contracts, they have the cash reserves, but they also have an undeniable track record of heavy losses and shareholder dilution. It's a high-stakes race between executing on their $275 million backlog and burning through that $641 million lifeline. So I'll leave you with this question to ponder. With all this momentum, is Voyager Technologies truly ready for liftoff, or are they about to run out of fuel mid-flight? Thank you so much for joining me for this explainer, and I highly encourage you to dive deeper into this fascinating aerospace sector yourselves. Catch you next time.